business news, we're news for business people.
Good afternoon and welcome. You're watching Bloomberg Quint Live. I'm Alex Matthew and here are the headlines. Lackluster trade in the markets with Nifty attempting to reclaim the 10,450 mark. Pharma players lead the gains while media and FMCG stocks dent the sentiment. Divi's Labs posts its highest intraday gain ever after the US FDA removes the import alert on its Visakhapatnam plant. Hexaware is another stock that's touched a 3-year high after the IT company posts a good set of numbers in the second quarter. And Vedanta along with PowerGrid are the key Nifty earnings that will be reported later today. And with that, it's over to Darshan Mehta with Hot Money.
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Joining us on the show today is Avinash Gorakhshekar of Joint Capital Services, Senthil of Newberry Capital, and independent investor advisor Vivek Mawani. Today on Hot Stocks, we will discuss stocks like Raymond, Relaxo Footwear, Syntex Industries, Apollo Tyres and NCC. Let's talk about the first stock, and that is Raymond. The counter has almost doubled from the start of the year. The numbers came out a few days ago. The numbers were strong. The management commentary was very strong, indicating that the third quarter they expect a high single-digit revenue growth and margins will be back to the pre-demonetization level. So commentary coming in, is this stock worth your money? Let's ask our guest, Avinash. Are you bullish or bearish on Raymond, and what kind of view do you have?
No, I think I'm positive on Raymond, primarily because the Q2 numbers which came in, Darshan, clearly indicate that there was a strong beat on the EBITDA margin. I think operational efficiencies, operating leverage seems to have kicked in, and the management was pretty confident that for the second half of FY18 also operating leverage would help the margins to improve. My sense is, I think clearly, the garmenting business obviously underperformed, but if you look at the apparel business, I think that did pretty well. I would believe that FY19 could be a year to watch out, and yes, in the near term, the management has also said that the Thane property is now on the watch list. That could be a near-term trigger. I would definitely look at this stock from a next 12 to 18 month horizon. In the near term, valuation seems to be well priced in the stock. But yes, if one were to look at a 12 to 18 month horizon, any dip should be looked upon as an opportunity to buy it.
No, let's leave aside the Thane land, because they've been discussing it for years and years and nothing has happened. So except the Thane land, do you still see traction in their core business? Do you think that has the scope to increase? Do you believe what the management says in terms of the efficiency that will come out in the next few quarters?
I would definitely look at EBITDA margin improvement. Yes, top line growth may not come in FY18 in the second half, and obviously in terms of the bottom line, in terms of the earnings growth, Darshan, I would believe that a strong earnings growth trajectory could happen in FY18 as well as FY19. Now that is something the markets are positive upon. Last year they did a bottom line of about 36 odd crores. This year we could see a profit of 85-90 crores. So and that probably could possibly see a doubling. Probably if the number gets into positive territory, especially the top line growth. I think a lot of improvements seem to be made by the management, and I think FY19 would be a year where both the EBITDA margin improvement in terms of the absolute gains as well as the bottom line could be significant. So markets are possibly pricing in FY19 numbers, which probably in FY18 looks a bit expensive.
Okay, what about you, Senthil? Are you agreeing to what Avinash is indicating? What's your view on Raymond?
Yeah, I agree to Avina's points, and to add to some of his points, if you look at Raymond's business, actually the men's apparel market in India is around more than 20 billion market, and Raymond has a good brand recall, and they have around 1,000 retail outlets. It's across India, and so one thing Avinash mentioned is about the cost optimization thing. So if you look at the free cash flow generation of the company has been in negative, but if you see the sales from the outsourcing thing, it has grown from 450 odd crores to around 2,000 crores last year. So going forward also, what we are expecting is that since this increase in outsourcing thing could result in lesser capex, and it would result in free cash flow generation, and if you look at the net debt of the company is around 1,700 crores. So further the company could see reduction in net debt.
Okay.
So we are positive, neutral to bullish on the stock, and since neutral because of some of the promoter concerns still exists.
Okay. That's a 2 thumbs up from Raymond. Do you think some of the concerns, the positives that they have pointed out, do you agree with them, or do you agree with the last point that there are promoter concerns?
I would actually, just on promoter concerns, the management leaves a lot to be desired in terms of governance, in terms of transparency, and most important, operating performance. I mean, it's one of the finest companies or finest businesses. Let me correct myself. It's the finest businesses in terms of very strong brand in textiles and branded garments. Park Avenue, Color Plus, 1,000 plus, as he mentioned, in terms of exclusive distribution network. I mean, it's got a deep moat as in the classic value investing. But the management really screws up the business, because if I were to look at their long-term growth, their margins, I mean, it just leaves a lot to be desired. I mean, 2,000 plus crores branded garments business hardly is profitable. When I look at similar branded garments companies, a Keval Kiran earns 25% EBITDA margins, 50% return on capital. An Indian Terrain earns 12-13% EBITDA margins, 20% return on capital. A CRM, which is directly in terms of branded textile, the fabric business, even a CRM earns a return on capital of something like 18%, and Raymond even struggles with 5%, with a very fine business, brand, distribution network, everything. So there's something fundamentally wrong with the management, that over the long term, they have just not delivered numbers as far as the P&L account is concerned. The land sale, as far as I can recollect, I've been hearing about the Thane land from the time that I started my career 22 years ago, quite honestly, and nothing really has happened. Given the credibility of the management, if at all it does happen in the, let's keep our fingers crossed, I doubt if the gains will flow to the shareholders. The management doesn't give that confidence. So for me, it is a clear avoid. There are better opportunities available. The stock has done very well. I've missed out on the opportunity, but I'm far more comfortable missing out on an opportunity in Raymond than to be like sticking my neck out.
Okay, but the management concerns, obviously they are valid because of the past record, but past track record. But they've changed now. It's more of a professional run management. They are giving strong commentary in terms of what is happening, and it seems that they are looking to turn around. So would that?
Well, I've been hearing the strong commentary for the last 18 months, if I can recollect. I mean, I have been attending their investor meets also. But I would like to see a lot more in terms of actual performance. That's all I'm saying. Okay. I mean, we have been hearing of positive commentary for the last 6 quarters that I can remember. Could be even longer, because it's only about 6 quarters ago that I started looking at them closely. Since then, obviously, the stock has doubled. I've missed out, but I think I'm comfortable doing that.
Okay, so that's the view that's coming in on Raymond. Both Senthil and Avinash are bullish on the counter, but Vivek is saying that it's a clear avoid at this point of time. Better opportunities in the space, since the fact that, you know, return ratios which some of the other companies give are much better than Raymond at this point of time. Let's move on to the next stock, and that is Relaxo Footwear. The counter has been buzzing for the past few days, and no doubt today is down 3%, but no doubt the Khadim IPO is something that is, you know, playing on the mind of investors. So a lot of these companies, Relaxo, Liberty, Bata, had managed to move up. What should one do with Relaxo? Is it a good company to invest? What should one do? I'll start with you, Vivek, here. Are you bullish on Relaxo, or do you prefer something else here?
Long term, I am bullish on Relaxo for multiple reasons. It's a classic long-term portfolio stock that you can buy and hold for 2, 3, 5, 10 years. It's a good business segment to be in, branded footwear. Relaxo has proved itself over the years in terms of consistent and higher than industry growth in terms of sales and profits. Return on capital, return on equity of about 25%, debt-free company, free cash flows, and so on and so forth, which no other company, if I were to look at a Bata or a Liberty, and I mean, none of them really can match that kind of a track record. That's one thing. Going forward, there is a huge opportunity in terms of the entire move as far as the footwear itself is concerned, from unbranded, unorganized segment moving to branded, organized, and Relaxo is well placed in that, with branded products right from the mass market, your Hawaii chappals, the slippers, what we call, to higher end, including sportswear. They also have forward integrated to have their own retail store. So from manufacturing to retail, they capture the entire value chain, which is what is also leading to expansion of margins over the last 5 years. So margins have moved up from about 10 odd % about 5-6 years ago to now almost 15% current year. So I will be very positive on the stock over the long term. valuations, no doubt, at more than 50 times earnings is expensive, but I'm willing to pay the higher price for a good quality company and a stock.
Okay, so that's the view on Relaxo. Avinash, do you agree with the points that Vivek has been making, or you have a different view?
No, I think, I agree to the point that, the company is well known in the low priced categories. They have their three major brands, that is Flight, Spark and Bahamas, which actually cover up the entire business. But valuations, Darshan, look to be quite expensive. 50 times for a stock within the footwear space. I think largely the stock had run up because of the Khadim IPO. Most of the leather stocks had moved up. So I would prefer that, something like a Bata, which is much more larger in space in terms of the product, in terms of the geographical reach. They have a price point covering the mass market to the premium market. And I think if somebody were to pay 7,000 crore market cap for a company, like Relaxo, I would prefer to give a kind of premium to Bata, which enjoys roughly about 9,500 crores of market cap. And clearly, with the kind of cost optimization strategies, with the kind of margin improvement I perceive in Bata, I would believe earnings growth for Bata could be much stronger than Relaxo, at least over the next 2 years. FY20 possibly, we could see a much stronger Bata, and probably the risk reward, in the same time frame, if one were to compare Relaxo, Bata would definitely be a better candidate. So I would prefer to avoid Relaxo and look at Bata more closely.
Okay, I'm just throwing it at the dark. Do you have a view on the Khadim IPO? Just for if would you track it, or what's any view?
Darshan, frankly, it's an open offer. It's an offer for sale, and hardly 50 crores comes to the company. So I would prefer to wait and watch. It's a very large player within Eastern India, and valuations, the kind of valuations which work out, on the IPO price, I would not be surprised that it would not offer a very high risk reward, at least initially, for listing gains. And obviously, going forward, one would like to see the sustainability in these numbers, because clearly, this is one company which has obviously built a network from scratch. It's a domestic play, but I would definitely wait and watch. Not saying that it's not a good company, but I mean 1 or 2 quarters and then probably take a call.
Senthil, on Relaxo, one bullish stance, one bearish stance. What's your view?
So we are neutral on the stock. Basically, it's a great business. I agree to the points put from the other two guests, but it's not a great investment, because if you look at the price to earnings multiple, it's around 60 times, and if you look at the profit growth, the CAGR in the last 10 years is 30%. And we have to factor in the fall in rubber prices over the last 6-7 years. So if you go to the PEG ratio, it's around 2x times PEG ratio. So I accept to the points like it has a steady profitability growth, healthy balance sheet, ROE of 25%, debt-free company, and they have good brand recall. And so these are the positives, but it doesn't make a great investment at this point of time.
But why? On valuations, are you saying that?
Valuations, yeah, it's a great business, but not an investment at this point of time, because it is discounting next 3 to 4 years of earnings now.
Okay.
So that's the reason we are neutral on the stock.
Okay, so that's the view that's coming in on Relaxo at this point of time. Vivek is bullish on Relaxo. Avinash says it's better to play something like a Bata, and Senthil believes that at this point of time the next 2-3 years earnings is actually factored into the valuation, so he would be neutral and wait for it at a later stage. The next counter that we are talking about is Syntex Industries. Even this has been one of the counters which has been buzzing ever since it demerged and the plastic division got listed at a later stage. But Syntex as a company has managed to double in the last 1 year. So what should one do? Now Syntex Industry is a pure play textile company. Should one look at Syntex or should they move on to something better? Let's ask our guest. Senthil, I'll start with you. Any view on Syntex?
Yes, we are neutral on the stock. If you see Syntex Industries, they have currently put up the compact yarn business. So if you look at the compact yarn, average realization per kg is around 225 rupees. Compared to the normal combed yarn, it's around 190 rupees. So it's a high margin product, and the company is put a capex of around 4,300 crores for this project. But if you look at the industry wise, if you look at many players are putting up the capacity in the compact yarn. For example, SVP Global, they also put up the compact yarn facility of around 1.5 lakh tons. So this capacity coming up in stream is because of the incentives offered by the state governments and the central government.
Yes.
If you look at this state government interest subsidy of 7%, plus the TUFs from the central government is around 2-3%. So the effective interest cost is for 2% of these players. So I think on the positive side, the sales growth will come in, but whether it will translate into profits, I'm not just negative on that. And if you look at the textile industry as per se, they haven't been any major wealth creators in the last decade. apart from a few players like Ambia Cotton, there hasn't been a major wealth creators because industry per se, if you look at, they put the capex now, and next 5 years it becomes absolute. Then once again they have to plug in the cash.
Okay.
So it doesn't, the cash doesn't get into the shareholders.
Okay. Do you agree, Vivek, that textile companies tend to not make wealth for shareholders? And any view and what's your primary view on Syntex Industries?
I'll answer both the questions. Textile companies, there are exceptions of textile companies also having made wealth. It's not that they don't always do it. Yes, majority of the companies have not done that. That's true, because the business economics don't seem to be in favor of textile companies in the long term. It's a business which inherently is a company inherently of low return on capital and low return on equity, high debt, and so on and so forth. I mean, it's capital expenditure intensive over a 5-year or 10-year period. Coming to Syntex in specific, the management, again, the quality, their performance leave a lot to be desired. A company in very low margins, low single-digit EBITDA margins. Return on capital, return on equity, again, like in the vicinity of 4 to 6%. I mean, I don't think in the long term can really generate wealth for investors. That's one thing. Until March of 17, when the plastics and the textile business was as one, the bad performance of textiles was getting camouflaged with a good performance in plastics, because the plastic business generates maybe about 12% return on capital, maybe about 15% return on capital, about 12% EBITDA margins, and which is likely to improve. Now that the two are separated, one needs to see whether textile business can really stand on its own feet and with the debt that they have on the balance sheet, etc. The management track record also leave a lot to be desired. And the last point I would like to add, what you started off with, the stock has been buzzing since the time of demerger, but as far as I can see, the stock has only been buzzing. There actually have been no returns, because last 6 months, the price range of this company has been 25 to 35, and that's where even now we are. There have been a lot of reports of likely improvement, but those factors don't really give the confidence, because again, the likely improvement story has been going around for the last 3 years, even before the demerger, and that story still continues. I would love to see some concrete actual operating improvement, which the management doesn't give me the confidence.
Okay, what about you, Avinash? Do you agree to? I think the consensus here is that not the best time to invest in a Syntex industry. What's your view?
No, I think he had. I mean, our colleague had a very right perspective. I think the return on capital employed and return on equity are extremely pathetic. 3 to 5% is extremely low. And more importantly, I think this quarter numbers, the second quarter numbers, which was a very direct comparable quarter, was extremely bad. In fact, operationally, EBITDA was down by 11%. And the management themselves committed that until the fourth quarter of FY18, they don't see a revival in demand levels pre-GST. So, that's going to be a tough year, that is FY18. I would say that, unless we see core earnings coming back, operating margins improving, I think it's better to avoid and yet wait till, the business recovers. So till that time, my sense is, this is a stock should be avoided.
Okay. So it's a clear consensus view on Syntex industry that this stock should be avoided. Before we move on much ahead in the show, here's a quick recap of what the guests have already covered, have already told us in the stocks that we've covered till now. Okay, the next stock is Apollo Tyres. Numbers came out overnight yesterday. Not the best of numbers. The counter down 2%. Extremely weak set of numbers. If you're looking at it, revenues, even though revenues were up 13%, profit was down almost 46%, and margins coming from 14% to just 10%. What should one do as far as the tire stocks is concerned? Should someone stay with Apollo or move their portfolio? If they want to invest in the tire space, should they stay with Apollo or go somewhere else? I'll start with you, Vivek. Apollo Tyres, what's your view on the counter?
Well, I'm bullish on the tire sector, but bearish on Apollo Tyres. My preferred bet is actually JK Tyres. The factors which, let me first come to the positive factors as far as the sector is concerned. The likely benefit of lower rubber prices, but the joker is the crude prices. So your synthetic rubber prices could be heading higher. I mean, with crude at $55–60 range. GST destocking and slowdown in sales between June and August is now getting corrected. So we should see a healthy high single digit to low double digit volume growth going forward for the sector itself. The third thing, the anti-dumping duty on truck and bus tires gives them slightly better pricing power in that segment, which is actually the largest segment by value, which is almost 50% of the tire industry or tire sector sales are truck and bus tires, including radials. Now, that's a positive for the sector, which all companies would benefit. I'm more specifically bullish on JK because the growth to valuation matrix, JK Tires is much better. Both Apollo and JK do about 1,000 crores of consolidated EBITDA per year, about 250 crores of average EBITDA per quarter. Apollo Tires market cap is about 14,000 crores, JK Tires is 3,500 crores. JK Tire last year acquired the Haridwar unit of Birla Tires, which was loss making when they, or which was actually shut when they started. It was loss making. Now there has been a turnaround there, which will, so from loss to profit, the JK Tire will see a better expansion, margin expansion in the second half of the current year, the third and the fourth quarter, and financial year 18-19. So your earnings growth in JK Tire is going to be higher. Valuation at about 4 to 5 times EV by EBITDA. JK Tire is significantly at a discount to Apollo. And third thing, as JK Tires for the next 4 years, they are done with all the capex. So the operating cash flow and the free cash flow is going to be a similar number, which they are very committed to reducing the debt, which is roughly at about 5,000 crores now. Management is committed to bring down the debt to about 2,500 to 3,000 crores range over the next 2 to 3 years. So JK Tires to me offers a better valuation to growth matrix than Apollo.
Okay, also Senthil, Apollo, if not Apollo, what then?
So I agree to points put from the other cars, like JK Tire is a better bet. But if you look at the tire industry as per se, two things plays a major factor. One is the rubber prices and the second one is the imports from the China. If you look at rubber prices, in FY12 the price was around 250 rupees per kg. At that time the tire companies were making a margins of around 8 to 9%. And in FY16, because of the fall in rubber prices to around 95 rupees per kg, the tire companies margins went up from 9% to 16%. And now since the rubber prices has gone up, inching up, and the margins have been factoring in impacting on Q2 results, we saw the margins of the Apollo tires. So second one, it's a positive, like the government's anti-dumping duty on Chinese tires, it's positive. And the one thing is unique to Apollo tires is we have to analyze their European operations. Like they are putting a major capex in Hungary. It's a 450 million euro project. So the ramping up of the projects will play a major role because currently their Netherlands facility is a high cost structure. If you can Hungary, the labor cost is 50% cheaper compared to Netherlands. So ramping up of their European facility will be a major factor concerning Apollo tires.
Okay. What about you, Avinash?
I agree with what Vivek said and Senthil said. I think the near term will definitely be painful for Apollo, considering that rubber prices have moved up, crude has started moving up, and I think the numbers for the second quarter are clearly reflective of that. I would believe that probably within the radialization space, this is a large player. So if one takes a longer term call, we are neutral on the stock. I don't think the truck market is going to underperform. It would obviously take off. The Hungary operations would be a near term trigger, and I would believe that one has to take at least a 12 to 18 month horizon here. In the short term, maybe FY18 is going to be a difficult year, but FY19 could be a lot better, hopefully, if the rubber prices move down and obviously Hungary takes off. So I would be neutral on this.
But what about the entire tire space? Are you bullish? Are you neutral on the entire tire space, or is there a stock that you would probably like? In
fact, Darshan, if I were to play the auto component play, I would prefer companies which are not in the tire space. So tire space for me is not going to offer a very high risk reward multiple. In fact, in terms of valuations, what Vivek said is right. Maybe JK Tires could move up because there's a big discount to Apollo. But in the overall scheme of things, over a longer term, I think companies like say Motherson, Bharat Forge, or typically Ramakrishna Forging, auto plays could be played in that format because there I think the earnings growth story could be much stronger.
Okay, so that's the view that's coming in on Apollo Tires. Pretty much all our guests are neutral on the counter. Not too many positive views coming in. In fact, some of what Senthil also highlighted was the issue as far as the Hungary operations are concerned, which could actually take some time time to ramp up. Finally, the last stock of the day, Nagarjuna Construction Company. Will there be a revival as far as, infra companies are concerned? They all started buzzing when the entire Bharatmala projects were announced, including NCC moved up. Some of the smaller companies did move up. Is there scope? Is this just a hype? Will these orders actually come in? Will these companies be able to execute them? What's the future for infrastructure companies? Avinash, I'll start with you. Nagarjuna Construction as such, do you like it?
No, I think definitely we are neutral to positive on Nagarjuna, and in fact within the construction EPC companies, this is one company which has got a reasonable debt on the balance sheet. More importantly, the order book around 180 billion rupees is also strong, and as you rightly said, the environment for these companies is now getting better. I think the government has announced the Bharatmala project, so that's a big trigger for EPC players like NCC. But more importantly, ahead of the elections, I would believe that infra projects would get a boost, and obviously spending on water, irrigation, typically roads, housing, these are pockets where we could see a lot of incremental new order flows coming in to players like NCC. So obviously from a longer term perspective, the stock can be held on. The stock has run up quite a bit, but I would believe that, looking at the balance sheet, the return ratios, this is definitely, one could definitely buy it maybe on a decline, but not at the current
return ratio is not one of the best. They are sub 10% on all parameters. So
no, I would believe that, within the given space, now probably the last 2 years were quite challenging. I would believe that, if you look at the debt on the balance sheet, it's about 1600 odd crores. The net worth is about 3,500 crores. So I think they are well balanced. Yes, they have some other pockets, like they've got BOT projects of roughly 5 or 6 projects. So that could also be a value unlocking opportunity at a later stage. Maybe FY18 may not be all that great, but FY19, hopefully, if these projects take off and the execution moves up, execution has been pretty challenging, and I think that is going to be the key trigger. New orders would obviously boost the stock price, but earnings momentum would come in once execution comes.
Okay, what about you, Senthil, NCC?
So we are neutral to bullish on the stock. Particularly, we are bullish because of the order inflow that the company has been getting. In Q1, the company has received the order inflow of 6,000 crores. And for the whole year, the management guidance was around 10,000 crores. But the management expects to surpass 10,000 crores of order inflow. So currently, the order book of around 19,000 crores. So there is a 2 years revenue visibility for the company. We have to watch for the execution of the company side. And the second one is on the balance sheet side. If you look at the FY14, the debt was around 2,400 crores. Now the company has reduced their debt consistently over the last 3 years. It stands around 1,600 to 1,700 crores. And subsequently, rating agencies have upgraded the company's debt to A minus. So that's also positive. Going forward, they may get at a lower interest rates. So operationally, we have to look for how the execution goes for this company.
Okay. Vivek, you don't track HCC, but any pick, very fast, any pick in the infrastructure space?
Well, no particular pick per se, but I would at this point of time actually avoid the infrastructure space. There's just too much of buzz around the news flow without actual improvement in order flows or the performance of the companies. I would wait for a correction for all the excitement to subside, and it's only then that I would take a call on any infrastructure company.
Okay, so that's the view that's coming in on NCC, our final stock. Vivek is avoiding the infrastructure space, but our other two guests are very bullish on Nagarjuna Construction Company. Before we wrap up on the show, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, Vivek, Senthil, Avinash, thank you so much for joining us on the show. With that, it's a wrap on today's Hot Money. Thanks for watching Bloomberg.